Hello everyone, welcome back. Michael again with Life, Love and the Pursuit of Real Estate. I wanted to quickly cover the attitude towards the anticipated financial correction that everyone says is coming. And I'm certainly not in denial with it, and I'm certainly not over optimistic that it won't happen. But what I'd like to cover a couple of things. There is a shitload of media around at the moment that relates to people really wanting the market to get depressed. The real estate property market and the share market and the bond market. And what I'm finding with that is, and I've had, there is quite a bit of, everyone loves to make a comment on social media and everyone likes to have a crack at you when they think you're wrong. And of course they can do that because they're doing it from a distance and they've got no close interaction with you, all those things that we know. And I welcome all the comments that I get, good, bad or indifferent. But there's a few things that occur to me when comments come in, good and bad. And the first thing is that with a lot of the millennials, a lot of the people that want to buy into the market really want the market to drop so they can buy in. I get that. I understand that. But the current statistics that I read this morning is that Sydney's dropped somewhere around 8% and Melbourne's dropped around 4%, give or take on the overall median price. Now, it's anticipated that it's going to drop a little bit more. So a few things may happen with that. If the market drops a bit more, you may end up getting a flood of property, or what may happen is you may end up getting a decrease in the availability of the property, which can balance price out. And what happens is that people that don't really need to sell, if they think the market's going to drop, they just won't sell. Now, based on what we know about interest rates and the fact that they've already started to rise, there's going to be an affordability factor. And if you've been living in an igloo or a bubble, going back when you bought 2 or 3 or 4 years ago, and you thought the interest rates weren't going to rise, can I tell you, that's your fault. It's really clear. That's your fault. And, stupidity reigns supreme sometimes when optimism is overwhelming. So what we need to be very clear that when you buy something or when you invest in something, that the asset value of it will remain relatively calm, right? But the cost value of it in relation to maintaining it, that you can afford that later on if it goes up. So it's a very different way of looking at when you buy. Now, and sometimes it could be your investment advisor or your real estate agent that really should be advising you of that. And that's why I always say that real estate people have a obligation to be able to educate the buying public. Good real estate people are educators, not salespeople, in my opinion. Now, having said that, one of the things that I think may affect the property market is the asset value of shares and companies. And what I'm finding is that as we see fluctuations in the US stock market, and we've had some fluctuations here, but nowhere near to the same extent, it shows that a lot of people have faith in the asset value of Australian shares, where with a lot of the higher tech companies from the US, the values are a bit like that. And that's because they're overvalued in the first place. So when you get someone dumping a whole lot of stock, to try and keep it simplistic, it generally means that they think the asset value is going to fall through the floor and they're over leveraged on it. And one of the other things that you'll get is speculators in that market are generally very, 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 very heavily leveraged on share values, more so than they are on property. And I leave that thought with you. So I say this to you. Are we headed for a GFC that everyone predicts? And there is a heap of predictions that that's going to happen. I still think we're in for a correction. Where the correction remains, I don't really know. And I don't think anyone can predict a percentage. And I think anyone that does predict a percentage want to have a lot of good bloody facts, because I've not known anyone that's been correct on that score. They can predict that there's going to be a regression of price or a regression in asset value, but they can't necessarily predict the actual percentage it's going to drop. So take into account in the video that I said some time back, and I can't remember what number that was, John, but where I was talking about the market factors, right? I still think those market factors keep the market fairly buoyant. What I do know though, is I do know that a lot of parts of Australia are going to still have a significant population increase. So AMP let an article out the other day, and I'll just quote you some stats. AMP say that their market predictions are that there's going to be a decline of about 20% in value of asset of property across Australia. Now, I'm not sure how they worked that out, but some of their other factors that lead them to this opinion sort of make some sense. They say between higher interest rates, that's going to diminish a lot of investor interest. But what has happened is this article spoke about how, for the first time, as these interest rates have gone up lately here, especially here in Melbourne, we are seeing an increase in interest, sales, and a slight increase in price in regional and seaside areas, especially here in Melbourne, on the perimeters. Now, we've never seen that before, especially when the market's correcting itself in the CBD, because normally our regional areas and our seaside areas, they're the last to increase and the first to decrease. Now, at the moment, we're seeing a lot of people shifting, and what's actually happening, and I think one of the reasons for that is a lot of the baby boomers in Melbourne, which is my era, right, and born in 62 in those 60s era, what they're doing is they're now going out for either a tree or a sea change. On that score, we're seeing people move out to the peripheral areas, A, for cheaper living, and B, they're just looking for a much better lifestyle. Whether it's ocean or trees or country, right, is irrelevant, but people are moving out. Now, the other factor that's affecting that too is that with our migration policy, as we're letting people into the country, the government are now putting in place restrictions on people living in CBD when they come straight to Melbourne or Sydney or Adelaide or Perth or wherever. So therefore, they're actually requesting that they live out in country areas, right, which is helping rental values, etc., for the first 3 to 5 years. And I think that's still in deliberation at the moment at federal level. But the reality of that is that policy is currently in, and it's going to be fixed shortly for a particular term and period. So I think that will also help our regional areas grow. Now, with the event of all the infrastructure spending that we've currently got here in Melbourne, what we're also finding too is that there's going to be a lot more work available in Melbourne, and we're getting a lot more people still coming in. And I have mentioned this in the previous video, but if you are waiting for the market to drop, you could be the most prudent person watching this video. But my opinion is that the correction is still in play, but the correction hasn't found a base. And when you'll know when the base is found with the correction after it's already done. That's how you know, after the event's already concluded. So if you are looking for investment properties, or if you are looking for a home to live in, whatever it might be, you have a certain criteria. But when it comes to the investment cycle, I can tell you, when you look at interest rates and when you look at what you can afford, you need to put in a margin. And my belief has always been that you need to save 20% of your net income every pay period to live a really good life later on. And you need to do that for a minimum of 10 to 15 years. And that will secure your position. But the other thing that secures your position is a understanding of a little bit of conservatism when you're purchasing. So you need to allow for the interest rate rise. How much it will rise, I don't know. But as you can see in the US, the interest rates have risen and everyone goes into a panic. They go into a panic not because the interest rate rose, they go into a panic because they don't know how far it will rise. So therefore, there is always a limit with that. So my suggestion to you is read as many articles as you possibly can. The Australian and the Financial Review here in Australia are a great read. They will give you a great picture of the general market, right? Understand that the asset value of shares at the moment in some areas, especially in the tech areas, are overvalued. So people are scurrying and getting rid of stock, right, which is actually affecting the stock market fairly quickly. But if you have a look at the stock market overall, it still remained generally buoyant in most areas, right? And there is still a return on asset with a lot of those shares. So I would say to you, if you're in the market to buy, read the papers. If you're in the market to buy, be conservative. If you're in the market to buy, go back to one of my previous videos and have a look at the key market driving factors that I still believe are pertinent right now. And when you are buying, ensure that you can afford it, and make sure that if you're paying an interest rate of 3 or 4 or 5%, allow for it to go to 8% and see if you can afford it. Then the purchase is worthwhile. Remembering, for those of you that are in Sydney or Melbourne, that the the statistics are very clear that Melbourne and Sydney are still undersupplied with housing, but that is segmented to certain suburbs. So you need to do your homework on those key market drivers that I've spoken about beforehand. The second thing that's going to affect us is the Royal Commission on Banks. So if you've kept up to date with that, you'll know that the banks are going through a change of lending policy. And what we think, or what I think will happen, is it's going to take the banks about 12 to 18 months after the Royal Commission to get all new lending procedures and policies in place in their organisation. So we're going to go through a period of probably ambiguity where the banks are going to be very unclear on what they're going to require from you to lend you money. So you need to be prepared for that right now. So therefore, the relationship with your banker is extremely important. The relationship with your valuer is more important. And the relationship in relation to your knowledge with your real estate agent, etc., is as important. So for those of you that are looking to buy, understand that the rates are going to probably go up quite a bit. The market's undersupplied, so I think there's going to be what they call an equilibrium between cost and sales rate. And I think that's going to be okay, especially for Melbourne and Sydney. And I think the adjustments in those two states is actually not a bad thing. I think it's actually a good thing and will give people confidence. But for those of you that are talking the market down 20, 30 and 40%, to be honest, most of you are only doing it for your own interest. And that's what I think, because I don't think that's going to happen to that extent. So I would suggest that you keep a very, very strong eye out on all the results out of the Royal Commission. I wish you good luck with your investment practices. Stay great.